Well, hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. We are already in the second week of the summer 2022 semester. This is a 6-week course, which means we cover about on average 2 chapters per week, which means you have 2 assignments due each week. So last week, which was our first week, you had the Chapter 17 discussion board and the Chapter 18 quiz. Every week, your 2 assignments are due on that respective Sunday night. So please make sure that you do your best to make sure that your submissions are done on time. The reason for that is this class is very, very busy. You get 2 things each week, so that means it's a very busy, busy time. It's 6 weeks, and it's still the same content. Everything that you learn in these 6 weeks are the same exact content that you would learn whether it was 6 weeks, 8 weeks, 16 weeks, whatever. It's all the same. It doesn't change regardless of the format. It's all the same content. So that's why it's important that you stay on top of your work because it's only a 6-week course. It's very, very imperative that you stay on top. Okay, along those lines, I want to call your attention to where we are in the classroom. We are in Module 1, Week 2. We are about to discuss the topic of job order costing, which is Chapter 19. There's a PowerPoint presentation and there's a homework assignment to accompany this discussion. You'll also see that in most cases there are exercises for each chapter. These chapter exercises, they are just exercises. What that means is they're not graded. They're just there to help you to better understand the content. I highly recommend that you try those exercises before attempting the quiz or the homework assignment. They are designed to help you to understand and practice what you're learning. Just as I mentioned when I taught Principles of Accounting 1, you know that accounting is a practice. And it's so important that you practice the concepts to really learn and understand how they are applied. So that's why I have the exercises for the respective chapters there for you to try out. And without further ado, let's go ahead and get started and begin our conversation on job order costing. As we talked about last week, I want you to get into the mindset, the understanding, the mindset of manufacturing. A lot of the concepts we cover in Principles of Accounting 2 are around cost. Cost is a very important concept to understand. The cost of making a product is very, very important for you to know. The reason for that is you need to know how to price that product. You need to know how to what everything that goes into creating that product, how to price that product, how to sell that product. As a manager, you need to know how all that works because if you don't know the cost of the product or the service, you will have a tough time pricing that product or service and determining how much profit you're making from that product or service. So it's really important that you understand cost. And as we talk about job order costing, I want you to think about manufacturing. And I want you to think about what goes into making a product. Last week we talked about things like direct materials, direct labor, and factory overhead. We know that direct materials, direct labor, and factory overhead equal the total cost of manufacturing a product. And with respect to those 3 components that we learned about last week, we know that direct materials, direct labor, and factory overhead are the costs of manufacturing a product. And when we talk about job order costing, I want you to think about how a customer places an order for the product to be made. And that's what job order costing is really all about. There's some technical components that we'll talk about, but really, direct material, direct labor, factory overhead go into making a product. The customer places the order for the product, and so we need to track the costs of direct material, direct labor, factory overhead to that customer order, which is also known as a job order. So let's talk about this in depth. And another thing that I brought up last week that I want you to kind of recall as we talk about this concept is we talked a little bit about what we call just-in-time manufacturing, which is used by uh, companies that create products just in time for the customer's order. That has a lot to do with job order costing as well, because when the customer places the order, the job order, it creates the order and we create the product just in time for that customer. So a lot of that has to play off of what we learned last week. And so that's why it's important that you recall what happened the prior weeks, because everything in accounting kind of builds on the concepts you learned prior, right? So it all kind of flows together at some point. So that's why it's important that you kind of recall those things. So let's talk about this job order costing concept and what goes into a job order. And what is a job order? How does it work? So a job order. Job orders are used in the production of large, unique, high-cost items. I want you to think about a car. We talked about the concept of making cars last week as well as an example. So I want you to think about how a car is built. A car is a large, somewhat unique, and a high-cost item, right? A car definitely is those things. Um, a house can be those things as well, right? They're built to order rather than being mass produced. Well, I should preface that. Some cars are mass produced. It depends on the company, really. Here is an example. Toyota, a Japanese auto manufacturer, specializes in built to order cars rather than having them mass produced. Chevrolet, a General Motors company, focuses on mass producing their vehicles rather than having them built to order. So that's the difference. So job costing, the example I want to use is Toyota, the Japanese auto manufacturer. They receive customer orders and they build based off of those customer orders, those jobs. Think of a job as building a car based off of the customer's order. The costs associated with that customer order can be traced directly to the job. In other words, I can track the amount of direct materials, direct labor, and factory overhead to that customer's job order. So being able to track those costs to the specific order or job is what job order costing is all about. And later this evening, in chapter 20, we'll learn about another costing process called process costing, which is a continuous flow of costing. We'll talk about that shortly as well. So job order. Again, I want you to think about a job order as a specific individual customer order. And we're going to talk about that from the perspective of ordering a car. The products are heterogeneous and there's a lot of different cars, is what that means. Heterogeneous means there's a lot of different customizations in products and services. They have what's inherently called low production volume. We do make a lot of cars, but we don't make a lot of the same car. So it's low production volume of a particular model, for example. These uh, types of customer orders are very highly flexible, meaning we can customize the product to the customer's needs. That's why you'll see cars with different features, right? Based off of the customer's needs. It's flexible. And there's relatively low standardization to the manufacturing process of an individual customer's car, individual customer order. And that's what we're going to talk about today as the job order costing. Later today, in chapter 20, we're also going to talk about process costing. Process costing has to do with the continuous flow of manufacturing the same product over and over and over again without stopping. An example of a process costing operation would be ice cream. Ice cream is continuous. Ice cream manufacturers manufacture ice cream regardless of an individual customer order. That's why when you go to the grocery store, you'll always see ice cream. Well, why is that? Well, it's a process cost. It's a process operation. They will keep making that ice cream regardless of who orders it. And they'll keep delivering it to those grocery stores regardless of the quantity ordered. The same can be said with water. Water processing involves purifying the water, putting the purified water into a water bottle, putting the cap on the water bottle, and it goes into a truck and gets delivered to the grocery stores. And that happens regardless of the customer order. It's the same product made over and over and over again on an assembly line. It gets pumped out. It's all the same. It's highly standardized. It goes high production, and it goes into the truck, and it gets delivered to the grocery store. So the difference here, when we talk about job order costing, I want you to think about specific customer specialized orders. When we talk about process costing, I want you to think about making the same thing over and over again, regardless of orders, in high volumes, like water bottles, for example. And so that's really the primary difference between job order costing and process costing. And I want to talk about how the job order costing works. When we make a car or any other product that a customer orders, we call that a job. Customer calls up Toyota and says, "Hey Toyota, I want you guys to make me a Toyota Camry." Okay, so what they do is they assign a job number to that customer's order for the Camry. And so the process begins. Now I have a job order assigned to the Camry. Well, in order to build the car, I need materials. I need aluminum, I need metal, I need steel. And I also need engines and etc. Right? So I need my materials. My direct materials are aluminum, steel, uh, and metal. Those are my raw materials. So I need to make sure that I have enough raw materials in my storage area for raw materials. And if I don't, I need to purchase them from my suppliers. So I get my raw materials. That's my direct materials. Now remember, when we talked about direct materials last week, direct materials are the materials I can trace directly to the product. They make up the majority of the cost of materials to manufacture a product. That's direct materials. In some cases, we also have indirect materials. Indirect materials are materials that I cannot directly trace to an individual product or an individual customer's order in this case. So indirect materials get assigned to factory overhead. And on a car, the indirect materials might include things like the tires. Okay, the tires I can use for any car. They're the same darn tires. Okay, so those are indirect materials. They make up a very small amount of the total cost, and I cannot directly trace those to an individual job. The tires for the car are indirect materials. They make up a small amount of the cost, and I cannot directly trace those to the job. So indirect materials are materials I cannot directly trace to an individual job or an individual product. So for example, the rubber for the tires make up a small cost of the car. I cannot directly trace that to an individual car. So it's indirect materials. Does that make sense to everyone? The difference between direct materials and indirect materials. Y'all good, right?
Yes, sir.
Awesome. Thank you, Peter. Okay. So then, so I have materials, which make up manufacturing cost. I also have direct labor. Well, labor in general. I have direct labor and indirect labor. Just as we talked about last week, direct labor are the hours and the hourly wages of the employees that are directly working on the manufacturing of the product. Okay? Direct labor are the employees directly involved in the manufacturing process of making the product. The example here is the employees working on the assembly line to build the car. Okay, that's direct labor. They're directly involved in the manufacturing process of making the car. They're direct labor. I can trace the number of hours worked by each employee times their hourly rate to the car, to the individual job order. I can do that for all the jobs. We do that through a process called time tracking. And we'll talk about time tickets and things like that in a little bit. But that's direct labor. I also have some indirect labor. Just as we talked about last week, we have the maintenance employees who clean the assembly area. Okay, they're not directly involved in the manufacturing process, but they're indirectly involved because they maintain the machines. Okay, they're the maintenance employees. They maintain the machines. They maintain a clean work area. They also do the oiling of the machines and the fine tuning, et cetera, et cetera. That's indirect labor. I cannot trace those wages to the manufacturing of a car because they service the entire area. Okay? I can allocate a small amount of that labor through factory overhead. The same for the supervisor. The supervisor's salary, I can't trace the supervisor's salary to one car because they're the supervisor. Okay? They're responsible for seeing the direct labor people. So that supervisor's salary, that's a part of overhead because they're responsible for the whole operation, not just one customer's order. Makes sense so far? Good, right? All right. And then, of course, we have the factory overhead. Factory overhead include things like indirect materials, indirect labor, and they also have things like rent, utilities, depreciation expense, etc. Okay, those are all a part of factory overhead costs. I can apply the overhead based off of the allocation base for factory overhead to each job respectively. Oftentimes, companies will use what we call a fixed factory overhead rate. And that's just simply a percentage of overhead, and we apply that to all the different jobs. And there's a couple of other methods. We'll talk about those probably next week. I believe they'll come up. But there are a couple of concepts when it comes to applying factory overheads, a couple of different ways to do it. But most commonly, companies use what we call a fixed factory overhead rate, and it's basically a percentage of the total overhead divided by a base, usually like machine hours or labor hours, etc., to find a percentage, which is the fixed factory overhead rate. And we'll talk more about that later on, but I just wanted you to kind of understand how overhead is applied. So we have direct materials, direct labor, and factory overhead, and these costs are allocated to each individual's customer job making the car through what we call a job order cost sheet. And this tracks the exact cost of materials, labor, and overhead allocated to each job. Then it goes from work in process to finished goods and ultimately comes cost of goods sold when we deliver the product to the customer. As you recall from last week, there are three types of inventory. There are raw materials inventory, work in process inventory, and finished goods inventory. Raw materials are the direct materials that we purchase from our suppliers. Work in process inventory are the work in process. It's the customer's orders that we're currently working on. That's why we call it work in process, right? We're not done yet. We started the job, didn't finish the job yet. That's why we call it work in process. When it's done, when the car rolls off the assembly line, it becomes what we call finished goods inventory, which means it's done and it's ready and available for sale. When we sell the car or the inventory and we deliver it to the customer, it becomes cost of goods sold. It moves off of our balance sheet and onto our income statement as cost of goods sold. And that's how we track the cost of the individual jobs or individual products, if you will. I want you to think about the physical flow of manufacturing. Think of the assembly line, okay? Just think of the assembly line. You know how an assembly line works? We start off with raw materials. It's just our metal, our aluminum, our steel, okay? Just hanging out there in a warehouse, right? And then when we're ready to start the job, we move the materials from raw materials, we take it out of raw materials and put it into work in process. And a work in process is when we're building the car, right? We're building it up. And then when it's done, moving down the assembly line, work in process, work in process, work in process. And we're also adding in some direct labor and factory overhead. And then when that's done, we take our work in process, raw materials, our direct labor, factory overhead. It's all done. The car moved to the end of the assembly line. We take all those costs and we move it out of work in process and we put it into finished goods inventory. And it's ready. The car's done. It's available and ready for sale. We sell the car. It moves off of our finished goods inventory balance sheet and onto our income statement as cost of goods sold. And so in other words, I want you to think about the physical flow, from starting as raw materials working all the way through work in process on the assembly line, rolling off the assembly line as finished goods, and then we sell it, cost of goods sold. That's the physical flow of manufacturing. And the cost of manufacturing follows the physical flow. So earlier I'd mentioned that we track direct materials, direct labor, factory overhead using this method called a job order cost sheet. The job order cost sheet helps us to track those costs. Because as I had said earlier, it's so important that we track the costs of manufacturing to understand the total cost of the product that we're selling. So think of the product as what we're selling to the customer. Okay? The customer's order. In this example, I think it's some type of like alarm company. They like build alarms and they ship it to the customer and they install it and et cetera, et cetera. But you can do the same exact thing with a car or any other customer order for that matter. This is called a job order cost sheet. It has a customer's name, address, the job order that we assign to it, the job order number that we assign to it, where it's being shipped to, the description of what it is that we're building, and of course the dates. The date we started it, the date we completed it, and sometimes the date we promised to have it delivered by. On every single job order cost sheet, you'll have direct materials, direct labor, and factory overhead. The direct materials, thinking about the car example, right? Thinking about the car example. Direct materials. I have steel, I have aluminum, I have metal, and I have components, we'll say. Okay? These are the four direct materials I have on the left here. You see on the left, $100, $225, $180, $95. These are all the individual direct materials I use to build the car. Okay? And I add up all those direct materials. I get 600. Four different kinds of direct materials. And you'll see that under each one, there's a requisition number. The requisition number represents the requisition form. Now here's how it works. Every time I need raw materials, I can't just go and get them, okay? Because sometimes I don't know how much I need. But most of the time I know how much I need. I need a way to track those direct materials I'm using in the job, okay? So I'll complete what's called a requisition form. I'm requisitioning, requesting, the use of those direct materials. And so I fill out the form and I say, hey, I need X quantity of steel, X quantity of aluminum, X quantity of metal, X quantity of components. And so I fill out a requisition form each time I need it. Okay, I need the steel first, then I need the aluminum, then I need the metal, then I need the components. And so I fill out a requisition form for each quantity. So it's quantity times price, right? To get the cost for each direct materials used. And so that's the process I take when it comes to allocating the direct materials to the job. I know how much quantity I need to complete the car. So I say, okay, I need this much steel, this much metal, this much aluminum, this much components. I requisition each type, get it in, record the cost. That's how I find the direct materials for each job, as I record it on the job order cost sheet. Got that down. Perfect. And of course, as I'm working on the customer's order, the job, as I'm working on building the car, I am using people to build the car. So I need to record the cost of direct labor. How do you do it? You take the amount of time each employee worked times their hourly rate. Amount of time the employee worked times the hourly rate. How much they're paid per hour, right? So, how do I do that? Hours worked times hourly rate. The employees that work on the job, they have what's called time tickets. You know how when you go to work, you punch in, then you punch out for lunch, you punch back in, and then you punch out to go home. On the time clock or whatever the heck you use, works the same way. What that machine is doing is it's tracking the amount of time you were working, right? We do the same things for jobs. We do it more specifically though for jobs. And the way it works is an employee will start recording the time that they're working on that specific job. Because an employee is typically there for like 8 hours or 9 hours or 10 hours, whatever. But they're not spending that whole 8 hours working on one job. Most of the time they're not. Most of the time they're working on multiple jobs at the same time. So how do we know how to track the amount of hours to that job? The way it works is the employee fills out what we call a time ticket. It's the exact amount of time that they spend working on this particular job times their hourly rate. Okay? So here we see multiple time tickets. L3393, 3422, 3456, 3479, etc., etc. These time tickets represent the amount of time specific employees were working on this specific job. Okay, this could be one employee or multiple employees. I don't know. The time tickets again are specific to the job, not to the employee. So this could either represent 7 different employees or it could be 3 different employees. I don't know. All I know is that every time somebody worked on this car, they completed a time ticket. The amount of time they spent on the car times their hourly rate. That's how you find the cost of direct labor. Does that make sense? You're all still good? You're still with me?
Yes, sir.
Awesome. Thank you, Peter. Appreciate that. So that's how you find direct labor. So direct materials, it's the material times the price or the cost of that material. So quantity times price equals the cost for direct material. For direct labor, it's the time worked times the hourly rate. And you do that for each material used and each amount of time used for direct labor. Now here's where it gets a little tricky. Sometimes people get confused when it comes to factory overhead. Factory overhead's not always a straight answer. Okay. Earlier I had said that most companies use what I call a fixed overhead rate, fixed factory overhead rate. Here's how it works. Here's how the rate works. The rate can be calculated in a few different ways. It depends on the company's preference, really. Some companies will simply say, my overhead rate is 100% of my direct labor. Or they'll say, oh, it's something. They'll make up a number basically. But there's a formula behind it. But what I'm getting at is that not all companies have the same percentage, okay? Because they factor it differently. They use what's called an activity base. This goes back to a concept that we may have done in Principles of Accounting 1. I really don't remember. I think we did. It's called uh, activity-based costing. I don't think we went over that yet. I think that's coming up though. Anyway, there's this concept called activity-based costing. What this is it's a way to find factory overhead. Factory overhead can be computed in really four primary ways. The first is to apply what we call a fixed factory overhead rate, which is the most commonly used, by the way, because it's the easiest. The fixed factory overhead rate is typically expressed as a percentage and is found by taking, we'll say, the total estimated factory overhead for the year for the company divided by the estimated number of employee hours expected to be worked, right? Also known as the total labor budgeted hours. And so we can get a percentage. In this example, it's 160%. So the fixed factory overhead rate that the company predetermined is 160% of the direct labor cost. That's how we found factory overhead. Again, the company allocated this amount. So in this case, 160% of $1,000 is $1,600. So that's what we apply to the overhead rate for this particular job. Does that make sense to everyone? So I know that that part can be complicated. Good. All right. Cool. Uh, so on the job work cost sheet, we added up all our direct materials, we added up all of our direct labor, and we added up all of our factory overhead. Materials plus labor plus overhead gives us a total cost for this particular job of $3,200. Now remember, the direct materials, those are the actual direct materials that we used for the job. That represents our steel, our aluminum, our metal, and then our components. Our direct labor, these are the actual hours worked on the job represented through time tickets. It's the number of hours times the hourly rate for each employee, or in this case, for each time ticket. And that's how we get the total cost. We add all those up to get 1,000. And then for the factory overhead, it's an estimate, and it's typically a fixed factory overhead rate, which is how we get the 160%. That part will be given to you. And it's 160% of direct labor cost. So 1,000 times 160%, 1,600. We add up total materials, total labor, and total factory overhead to get to $3,200 for this specific job. And that's how job order cost sheets work. And we would apply this total cost to that specific job for that customer. It's very and it's very commonly used. Most manufacturing facilities will use job order costing, especially when it comes to companies that are making specific products for specific customers. Uh, and that's really what job order costing is used for. I want you to think about the physical flow. The physical flow starts with, as you know, your raw materials. It goes into work in process, and then within work in process, we add in direct labor and direct materials. I'm sorry, direct labor and direct materials and factory overhead. And at the end, we end up with finished goods. When it comes to materials, I want you to think about how did the materials get to the raw material state? Well, we had to buy them. Okay, they didn't just appear out of thin air, right? I didn't just get the metal, the steel, the aluminum, the components. I had to buy that stuff from my suppliers. So I First, fill out a purchase order. Send it to my supplier. My supplier sends me what I purchased. And when they send it to me, they send me a packing slip, a receiving report, or I'm sorry, they send me a packing slip and a bill. Okay. And so what I do first is I fill out what's called a receiving report. It shows the amount of the materials that I receive from my order. And I put that receiving report information onto the respective ledgers. Now, you might hopefully remember this term from Principles of Accounting 1, ledger. As you recall, we have what's called the general ledger, which makes up all of the transactions for the company, right? The general ledger. And within the general ledger, we have what's called subsidiary ledgers. These are the individual accounts, okay? The subsidiary ledgers. The same is true for materials. We have subsidiary ledgers for materials. So if you look at our assets, which include our raw materials under inventory, we have the subsidiary accounts within raw materials. And these subsidiary accounts represent all of the individual types of raw materials. We call these materials ledgers. And you can see from this example, I have multiple raw materials. In my earlier example, I have steel, aluminum, metal, and components. Those are my raw materials. And within each materials ledger, I'll have what I purchased, received, what came in, right? What went out to customer jobs. So received is what came in from my purchases. What was issued went to the individual customer jobs, or went into work in process. And then I have a balance, what's left over. That's what I have left in that inventory, in that account. And I have that for all of my raw materials. When the materials are used for specific jobs, I have to complete what's called a requisition form to take it out of raw materials, put it into the job order cost sheet. That's where the issued part comes into play for the materials ledger cards. And it goes on to the job order cost sheet for the specific jobs that I'm requisitioning for. So that's where direct materials goes. I also have indirect materials. Remember the rubber for the car tires. Those are indirect materials. Why? Because they're not specific to the job. They're used generally, and they make up a very small amount of the total cost of the product. So those are indirect materials. So indirect materials would go on to the factory overhead ledger. So in this case, it would be rubber for the car tires. I requisition that from my materials ledger, goes to indirect materials, goes onto my factory overhead ledger. Make sense? That's how materials works. The same concept applies for labor. Labor gets recorded on the job order cost sheets as labor is introduced, direct labor, and indirect labor goes on to the factory overhead ledger. Same concept. So the materials ledger card looks something like this. Again, I made my purchases, which show up under my received area. When I purchase raw materials, it shows up under received on the materials ledger card. What I received, how much of it, what was the price, gives me the total. And when it goes out, it goes to work in process, assigned to a job through a requisition number, how much of it, what was the price, total price, and then I update my balances accordingly. really, in practice, all of this is relatively automatic because you'll be using something like QuickBooks or Sage or uh, NetSuite or some type of accounting software. Is what will update this type of information in practice, in real life. But as you're learning how to do it, that's why I'm showing you what all these look like. The materials requisition looks like this: job order, stock number, the date, the description, the quantity, who wants it, that type of stuff. Requisition form. All these forms help to build the paper trail, right? We talked about the paper trail back in Principles of Accounting 1. If you ever get audited, you want to be able to prove everything, right? And you do that through a paper trail. That's why it's so important that you keep all these records together, because it shows, it also prevents loss, right? But it shows where everything went. The materials requisition forms help to populate the balances in work in process. So as you know, there's in job order costing, there are individual customer orders. That's what a job is. And the materials that we use for each job are on the job order cost sheet. When we add all of those job order cost sheets together for the materials, we can find the total direct materials and update that for work in process. And this shows us an example of this, right? So if I add up all my jobs, I have $1,800 worth of materials that I'm using in those jobs currently. I need to take the materials out of raw materials inventory and put them into work in process. And we do that through a general journal entry. As you recall, general journal entries or adjusting entries are made at the end of the respective accounting period to update, reflect the consumption. So in this case, we debit work in process inventory to increase work in process inventory, and we credit raw materials inventory to decrease the raw materials inventory. All I'm doing is I'm taking it out of raw materials and putting it into work in process with this journal entry. Now remember, I debit to increase an asset account. I debit to increase an asset account. Inventory is an asset account. It's current asset. And I credit to decrease the asset account. So I debit to increase inventory. I credit to decrease inventory. All I'm doing is I'm moving it from one type of inventory to another. That's what this entry shows us. Again, it's very important that you track the flow of all of your inventories. Okay, labor. We talked about materials, got to talk about labor. I track the labor for each job using the time tickets. Time tickets tells me the exact amount of time that an employee spent on that specific job and what their hourly wage was. I take the amount of time they spent, time their hourly wage to give me my direct labor for that particular employee. I do the same thing for all my employees using all of the time tickets. And those go, of course, go on the job order cost sheet. For indirect labor, I have people like the maintenance employees, the supervisors' salaries, etc. Those are all indirect labor, and those get recorded to factory overhead as indirect labor. Here's an example of a time ticket. As the employee's name, the employee's number, the job that they're working on, the start and end times on that specific job. In this example, 3 hours. Their hourly rate is $20 per hour. That gives me a total cost for this one employee of $60 spent on this particular job. Now remember, I have multiple employees and multiple time tickets, right? So it's the number of hours worked times the hourly rate for each time ticket. So I get the direct labor. I add up all of my direct labor spent on every job during the time to find my total direct labor. Now I need to allocate that cost of direct labor to work in process inventory. Why? You know that labor is not inventory. We need to debit it to work in process inventory. Why? Who can tell me why? Why do we debit direct labor to work in process inventory? Who can tell me why we do that? Mike.
I can answer. My best guess is because the work's not finished. So once the work is complete, then you would get the full credit. You get your money basically.
Yeah, you're on the right track. That's basically it. So remember, with jobs, the customer ultimately pays, right? We get it through the revenue. But I want you to think about this because what you said is correct. Uh, the way it works is the employees worked on these respective jobs. I added them all up, and I'm increasing my work in process inventory. The reason why I'm doing that is, as you said, we're currently working on it and we get paid later. That's right. We're currently working on it, we get paid later. The reason why I'm increasing my work in process inventory is because, remember, the total cost of manufacturing is direct materials, direct labor, and factory overhead. So I need to increase my work in process inventory to represent the allocation of that direct labor to the cost of goods manufactured. So you got that correct, Mike. That's your line of thinking is accurate.
Okay.
Cool, very good. So I debit work in process inventory by the total cost of direct labor to increase my work in process cost. And I credit factory wages payable. Remember, when I credit a liability account, I'm increasing that liability. Remember, wages payable means I have not yet paid my employees. I have accrued the wages, but I have not yet paid them. That's what wages payable means. So I increase my asset and I increase my liability. The accounting equation is still in balance. So I debit work in process inventory to increase that work in process expense, and I credit wages payable to increase my wages payable. And of course, later on, I'll pay them. I pay them in 2 weeks from now, we'll say. But I pay them, right? And of course, when I pay them, when I end up actually paying my employees, I'll debit wages payable and I credit cash. Okay, so we talked about materials, we talked about wages. Now you know we got to talk about factory overhead. So factory overhead. This alludes to what I was talking about earlier with a couple of different methods of allocating factory overhead cost. One of those methods I had said is the fixed factory overhead rate method, basically. It's the percentage. This is also called the predetermined overhead rate method. It's basically just a percentage. To allocate factory overhead using the predetermined overhead rate, I take the estimate of the total factory overhead for the year, and I divide that by the activity base. The activity base can be something like total number of estimated hours to be worked, or in other words, the labor rate, or it could be something like machine hours or expected machine hours, something like that. It's the activity base. The activity base represents the hours worked, the hours ran on machines, or it could be something along those lines. Mike, please.
So that would basically mean it's the cost of the work getting done.
Yeah, exactly. Yeah,
Okay.
you're right. Yeah, that's exactly right. So the activity base is the expected cost of getting it done. So in this
Yes,
case,
they have to say. Oh, sorry, Kevin.
so it could be something like the number of hours the employees are expected to work during the year. So like we'll say and we'll just use this as an example. I estimate that my factory overhead costs are going to be 1.5 million for the year. Okay. And I also anticipate that my employees, all of my employees, will work about 16,000 labor hours for the year. Okay? So I'll take my 1.5 million, divide that by my 16,000 labor hours to get my predetermined factory overhead rate. Remember, the activity base is, as Mike said, the expected cost for that job, right? So 16,000 hours would be the expected cost. Or I could also use the expected total labor dollar as the base. It depends. But typically the base is either the total labor hours expected to be worked during the year, or it could be something like the total number of machine hours to be ran during the year, something like that. Does that make sense? Good.
Yeah. Isn't that better? So would so I'm guessing it would change if any issues came up with the work itself, depending on the work, and possibly any changes with like, for example, like with my job, I have PTO, and other people may call out, people may call in, that kind of thing. So I bet that would be a lot of variables, I would imagine.
It depends. Yeah, that's a good
Okay.
question, Mike. So that's why we call it an estimate, right? You know, because 16,000 labor hours for the year, like you said, things happen. You know, employees quit, or they don't show up, or whatever. So that
Or the
16,000,
work,
or
or
they
the
work,
work gets damaged.
or they work too much. You know, there's so many things, right? That could happen. So that's why we call it an estimate. You know, we estimate it'll be 16,000 hours. It could be more, it could be less, but it's usually pretty damn close. Like it's not going to be off by like 3,000. It might be off by a couple hundred. You know, that's why we call it an estimate. And if it's over, it's over. If it's under, it's under. That's the nice thing about estimates. It doesn't have to be exact. So that's a good question, Mike. And yeah, but yeah, that's typically what happens is that, and that's why we use an estimate because, as you said, things happen. Um, so yeah, that's an interesting factor. So that's what we call predetermined overhead rate. It's expected. Is it going to be actual? Probably not. It might be close. It might be close. Uh, and it's usually within a factor. You know, so that's why like really good managers are able to determine the estimates, right? Uh, it's like in accounting, for example, we look at the actual performance and we compare it to the budgeted amount. You probably remember when we talked about that in Principles 1. You know, you look at the actual performance, you compare it to the budgeted amount, and you're either over or under, right? And you do that for all the line items. The same concept kind of applies here. We can determine how much we're going to be over or under by. So that's why we estimate a certain amount. And of course, yeah, certain things come up and we might be off by a lot, but in most cases we're pretty damn close. And that, good managers able to estimate it within a certain degree. Sometimes I'm off by 5%, but that's still pretty damn good. If I'm off by 15%, that's a problem. But if I'm off by 5%, that's pretty good. Great question. So, in finding the predetermined overhead rate, I take the estimated overhead cost divided by the activity base. So, for example, $1.5 million of estimated overhead cost divided by the 16,000 hours expected to be worked in the year. That gets me my predetermined overhead rate. How do I apply that percentage to the overhead? I take that percentage, the cost divided by the hours. I take that amount and I multiply that percentage by the actual amount of hours used. So if I said my estimate was 16,000 hours, my costs are 1.5 million, I get my percentage. My actual hours come in at 14,300, whatever. I multiply that 14,300 by that percentage, and that gets me my applied overhead. The applied overhead, can be adjusted over or under later on. But we take that applied overhead and we record it, the actual overhead during the period. And then we make the adjustment at the end of the accounting period. It gets a little complex, but once you understand the values, you just plug them in, right? So the estimated overhead cost divided by the activity base, you take that amount that you get from the predetermined overhead rate, you multiply that by the actual amount of activity base used, or actual number of hours worked, whatever the base is. And that gets you your total applied overhead. Then you can do a plus or minus at the end when you take that and you compare it to the actual overhead at the end of the year. And then you just make your adjusting entries. We make those adjusting entries to cost of goods sold at the end of the year, just so you know how it works. I mean, it gets complex, but really there's a couple different methods for applying overhead. And the one we've been talking about is the predetermined overhead rate. Again, very common to use this method because it's easy. You take the estimated overhead cost divided by the estimated activity base. In our example, we said it was 160% of the total, what do we say? The total labor cost. We said that the overhead rate is going to be 160% of the total labor cost. That's how we determined it. And that predetermined rate was done by that calculation I just showed you. So we take the total direct labor cost, we multiply that by 160%, which gives us our applied overhead. So if my labor cost is 4,200, multiply 4,200 by 160%, which is 1.6. So 4,200 times 1.6, which is 160%, gets me 6,720. So I debit work in process inventory to increase work in process inventory by 6,720, and I credit factory overhead. Now remember this. The reason why we're debiting work in process is because the total cost of making a product is direct material, direct labor, factory overhead. All of those things get applied during the work in process when we're making the product, right? So that's why we're debiting work in process inventory. Of course, we're crediting factory overhead expense because we have to allocate the factory overhead expense. At the end of the year, I need to record my actual factory overhead, which includes indirect materials, indirect labor, and other factory overhead components like depreciation expense, rent expense, etc. And I need to increase my factory overhead by that amount. So, for example, at the end of the respective accounting period, the end of the month or end of the year, I make an adjusting journal entry. I debit factory overhead and credit, in this example, raw materials inventory to record the use of indirect materials. To record indirect labor, like manager's salary, for example, I would debit factory overhead to increase the overhead and credit factory wages payable to increase the wages payable. And then for other things, like depreciation, rent, utilities, insurance, whatever, I debit factory overhead and I credit those individual accounts. Depreciation, rent, payable, utilities payable, prepaid insurances. And this helps to record the actual overhead costs incurred during the accounting period. So to think about the allocations, think of it from the physical flow. We started with raw materials, went into work in process, it came out as finished goods. And then when I sold it, it becomes cost of goods sold. Started as raw materials. I used direct materials, it went into work in process inventory. And then within work in process, I added in direct labor, I added in factory overhead. When I finished the work in process, it becomes cost of goods sold. This equals the cost of goods manufactured. Direct materials, direct labor, factory overhead equal the cost of goods manufactured. We add those all together. The cost of goods manufactured becomes the cost of goods sold when we sell the finished good. When it comes to finished good, when it's finished, take it out of work in process, put it in the finished good. It's finished because it's done and it's available for sale. When we sell it, it goes from cost of goods manufactured to cost of goods sold. It comes out of it comes out of finished goods inventory and goes onto your balance sheet. Your income statement as cost of goods sold because we sold it, right? Revenue minus cost of goods sold equals gross profit minus your expenses equals net income. You all remember that story from Principles 1. But that's how it looks. This is the flow of the cost from the balance sheet out all the way to the income statement. And this shows us the flow, the physical flow, again, from raw materials to work in process to finished goods, the cost of goods sold. This kind of shows you what it looks visually by breaking it down with respect to the individual jobs. Now remember, the jobs can be at any stage. It could be a work in process, it could be at finished goods, and then when we sell the job or deliver the product to the customer, it becomes cost of goods sold. So this kind of shows us the flow. And this represents all of those journal entries that we reviewed that we make at the end of the accounting periods to show the flow. Raw materials inventory, accounts payable, that shows us purchasing new raw materials. We take it out of raw materials, goes into work in process, number 2. We take it we add in some direct labor. Number 3, we add in some factory overhead. Number 4 and 5, we add in some factory overhead again. Number 6, we pay our factory overhead. Number 7, we move it out of work in process, put it into finished goods. Number 8. Number 9, we're selling it, so we move it into cost of goods sold and onto our balance sheet and out of finished goods inventory. And number 10, we're collecting some. I'm sorry, we sold some of our stuff on account to our customers, debit receivables, credit sales. But these are examples of the types of journal entries that we would make at the end of the month, adjusting journal entries that we would make at the end of the month to represent the flow of those transactions. This one's good to know. This one's called the Schedule of the Cost of Goods Manufactured. This is also known as simply the Report of the Cost of Goods Manufactured. Remember, the cost of goods manufactured represents direct materials, direct labor, and factory overhead that make up the total cost of manufacturing. And so the formula is relatively straightforward. It's direct materials used plus direct labor used plus applied factory overhead equals the total manufacturing cost. Plus the beginning balance of work in process equals the total cost of work in process minus the ending balance work in process equals the total cost of goods manufactured. You'll need to remember this one because I'm pretty sure this one shows up, of course, on your homework assignment that's due this Sunday night, but it'll probably also show up on a certain midterm exam. Hint, hint. Now, we talked about this concept, over-applied, under-applied. Remember, at the end of the accounting period, end of the year, remember I made my estimates, right? My estimated total overhead, right? Estimated total overhead cost divided by the estimated number of hours to be worked, etc. My activity based to get my estimated rate of overhead, my percentage. At the end of the year, I need to compare those estimates to the actual overhead. Okay, and so I need to make an adjusting entry at the end of the year to reflect the actual cost. Because, Mike, just like you and I were talking about, those hours that the employees are expected to work, that may not happen the way we think it will. They might work more, they might work less, whatever. But we need to adjust at the end of the year. We call this the over application or under application of factory overhead. When the actual overhead costs are greater than the applied overhead costs, we need to debit cost of goods sold to increase the cost of goods sold, and we credit factory overhead to increase the factory overhead. That's how we adjust it. When the actual cost of goods sold, when the actual factory overhead is less than the applied factory overhead, the estimated, that means we put too much application. So I need to debit factory overhead to reduce my factory overhead, and I credit my cost of goods sold to increase my cost of goods sold to get the balance right. And these are the adjusting entries we make to fix any over or under application of factory overhead. It's really just like any other time that we make adjusting entries, right? The reason why we make those is to basically fix the situation, to fix the over application or under application of something. That's why we do any type of adjusting entries. Here's an example of us making an adjustment for under applied or over applied factory overhead. We debit the cost of goods sold, and we credit factory overhead. We do this anytime we under apply the factory overhead cost, meaning I didn't apply enough factory overhead. So I increased my cost of goods sold and I increased my factory overhead amount by making this type of entry. So just as we learned with respect to manufacturing a product like car, we have direct materials, direct labor, factory overhead, and we track those costs using the job order cost sheet. And it goes onto the job order cost sheet. Then when we sell it, comes cost of goods manufactured, then cost of goods sold. But just as we do that, you can do the same thing with service businesses. For example, let's say you're a dentist or a lawyer or an accountant. You're not going to have direct materials, okay? But you will have direct labor and you will have factory overhead. So you need to apply your overhead and your labor the same way that you would in job costing. The difference is, you're not going to have direct materials. You're going to have direct labor and you're going to have factory overhead. So this kind of shows you how you could use the same concept of job order costing for service companies. It's really the same concept. The only difference is, of course, is there's no raw materials or direct materials. Pricing. So when you price something, when you price a product, pricing meaning the sales price. When you price a product, you need to know the cost because you don't want to sell something below its cost, obviously. Because if you sell something below its cost, you're losing money on everything that you sell. All right? Don't do that. But you need to know your cost. That's why we go through these exercises. We know that the cost of a product is direct material, direct labor, factory overhead to make a product. For services, it's direct labor and overhead. We don't have direct materials for services. But it's important that we know what those costs are in order for us to properly price the service or the product. So here's a nice example. This one's for advertising, right? We have direct labor and overhead. Now, the method of pricing here that they're using is based on the individuals and their hourly rates. You'll see this commonly when you go to a repair shop. Let's say your car needs repairs, okay? And you go to the repair shop and it says that their hourly rate is $150 per hour. Okay, I want you to know something. The techs are not getting paid $150 an hour. They're not. They're not making that kind of money. That'd be pretty awesome if they were, but they're not. I guarantee you they're not. Okay. If you're working on cars, you're not making $150 an hour. I mean, that'd be pretty sweet if you were, but I'm sure that you're not. So when you go to the repair shop and you go, dang, this dude's getting paid $150 an hour. No, no, he's not. That is what we call pricing for the service. That employee's probably making, maybe $20 an hour, $30 an hour. If they're really good, $50 an hour. But I assure you, they're not making 150. So the way that repair shops figure out the hourly rate, right, the $150 an hour for the job, is that 150 an hour represents both labor and overhead. Okay, because remember, the repair shop has to pay rent, utilities, uh, indirect materials, etc. So that's why you see $150 an hour for a repair shop. It's not really that much, but what that amount represents is the direct labor and the factory overhead that goes into completing the job, completing the repairs. Does that make sense? Because I've had that question before from students where it's like, man, professor, I don't understand why a repair shop would charge $150 an hour to fix my car. Well, that's why. Okay, it's not just them lining their pockets because they're not making $150 an hour. They're charging you that because they need to cover their direct labor plus their overhead. That's where they get that figure from. Make sense? I know that's sometimes a question.
Yes, Professor.
Cool.
Yes, sir.
Great. Thanks, Mike. Thanks, Peter. Appreciate that. Okay. Uh, so that's kind of our discussion on job order costing. Now, as a reminder for this particular discussion, you need to complete in week 2, you need to complete your chapter 19 homework assignment. That's all related to job order costing. I'm going to go ahead and stop this part of the recording and we'll start a new recording for chapter 20. So hold on just 1 second.